Welcome in our weekly market wrap up. I know it's still early for some of you, so really appreciate each one of you for tuning in. We have quite a lot of topics to talk about. This has been a really exciting week, and I've been waiting for this weekly market talk. We had Trump pausing tariffs, we had a lot of volatility in the markets, we have yields spiking, a lot of macroeconomic data that came out this week. And we also have some interesting developments regarding future monetary policies. So today in this conference, we're going to talk about each one and see what we should expect next. So let me know if you guys can see what I'm currently sharing on the screen. Should be good. All right. So on Wednesday we had a FOMC meeting minutes, and this FOMC meeting, as always, has a very coded language. Let's say, as always, Powell came out and said that they will be waiting for additional data to come out, and that the Fed isn't particularly certain on where the economy is really headed next, and that the best thing they can do is to wait for additional data to come out, to wait for more confirmations and let the dust settle, especially with all of these tariff fears and the noise we've seen over the last couple of days, and let it all settle before they make any changes in monetary policies headed next. And I do think that this is the best decision they could have made, to wait it out, to wait for additional confirmations. And we're going to talk about that in just a few minutes, of why waiting for additional data is best rather than acting right now. I've seen a lot of people talking about a potential emergency cut. I think that would be very detrimental for the markets. And as I said, we're going to talk about that in just a few minutes. On Thursday, we had inflation coming out lower than expected. So the core inflation month over month came out at 0.1%. The previous reading was at 0.2%, and the consensus was for 0.3%. The same goes for the core inflation year over year. It came in at 2.8%, and the previous reading was at 3.1%, while the consensus at 3%. And the same can be said for the normal inflation. The inflation rate month over month actually came in negative at minus 0.1%, while the consensus was for 0.1%. And so across the board, we had lower than expected macroeconomic data, right? The CPI came out much lower than expected and lower than the previous reading. And on Friday, we also saw the PPI coming out month over month at minus 0.4%, and the consensus was for 0.2%. So that is a stone cold PPI that came out. That is the producer price index, and essentially the PPI front runs the upcoming inflation rate or from April, right? So the PPI essentially front runs the next CPI that will come out on April, as it tells us the inflation rate for producers, and so the prices, of course, then adjust. But that isn't particularly shocking to me that the markets didn't have a rally from this news that the CPI and PPI came in lower than expected, due to the fact that I think it was already priced in. It was already expected. I know the consensus says that, it was for higher, but considering how much commodities have gone down over the last couple of weeks, we've seen eggs going down by 70%. We've seen even so every product and every commodity has gone down, and the stocks as well. I think equity markets have a very important role in shaping inflation, right? When equity markets go down, that essentially front runs that inflation will also go down, due to the fact that when the markets go down, generally consumer sentiment also goes down, and so people aren't as willing to spend anymore, which leads to less spending. Less consumption leads to lower inflation. That is essentially how it goes, and due to the fact that prices have gone lower, it was expected that inflation will also do so. We can use the oil chart as a very useful confluence in predicting inflation. Oil is the main factor that affects inflation. I think that oil is one of the most important confluences we can use here. Of course, there is also the real estate market and so forth, but I think that oil plays a key role in shaping inflation. But I do think that markets didn't rally off of this news due to the fact that attention may have shifted towards household data and towards microeconomics rather than the macroeconomic side like inflation and so forth. So I do think that right now the focus is on economic growth, on consumption rates, and on household data, something that I've shifted my focus as well to. And we've seen the challenger job cuts having this major spike. Now, of course, it may be due to the fact that, the Doge administration has cut rates, has reduced some jobs, has made a lot of improvements in that department. And so this may be driven by a narrative, but nonetheless, we've seen quite a substantial spike in here, which is the largest spike in challenger job cuts since 2020, right? So this is, I think, why the markets didn't rally off of this news, off of the lower than expected CPI, because we also had a bad data point that came out. Okay, so that is something that I paid attention to, and I do think that right now we are at an inflection point in which the market can really go two ways from here, and the economy as well. I think that as I said earlier, the best approach from the Fed right now is to wait it out, and that is because of tariffs, right? Tariffs, for those that may not know, tend to be inflationary. In a normal environment, corporations pass costs to consumers, and so prices go higher. Tariffs tend to be inflationary. But in an environment in which consumers are tapped out and households do not afford the standard of living anymore, then in that case tariffs can become deflationary as consumption simply drops. And without consumption, inflation automatically goes down. And I think that we're currently at risk of seeing essentially the evil brother of a Goldilocks economy. So we all know what a Goldilocks economy is. It is an economy in which there is a very solid labor market, there is high economic growth, and a stable inflation. Now, the evil brother of a Goldilocks economy is quite the opposite. An unstable labor market, high inflation, and low economic growth. And I think that the Fed fears the potential evil brother of a Goldilocks economy. Because tariffs, if we really think about it, if tariffs continue like they've started and like they've gone over the past few weeks, then tariffs will bring the evil brother of the Goldilocks economy, in which there is high inflation, but households do not afford purchasing those assets and purchasing those products. So consumption goes down, but prices stay artificially high. And that is an environment in which there is high inflation but low economic growth. And due to that, the labor market is also unstable, because corporations do not afford, do not afford the salaries of employees and so forth. So that can lead to layoffs. So that's where an unstable labor market can also come in. So I think the Fed fears this. And we've seen something we'll cover in just a few minutes. We've seen a lot of instability in the bond market as well, signaling the fears of the Fed. And this is something that I'll make a video on, and I'll share most likely early next week. So stay tuned for that as well. So returning to this, normally we should have seen a major spike in equities and risk assets from this news, right? And I'm going to tell you why. Because inflation is at 2.4%, this is essentially where the Fed wants it to be. More or less, this is where the Feds want it to be. At 2 to 3%, that's the best range that the Fed really wants inflation to be. So normally from this news, this signals that, rate cuts are coming. Future stimulus is coming, right? This means that, quantitative tightening is close to an end, and that, we'll see a macro catalyst. So normally we should have seen a spike, but we didn't. So let me explain why we should have seen a spike in the first place. In this chart, we have the IWM to SPX pair. So essentially, risk assets compared to traditional assets. So risk equities compared to traditional equities in the S&P 500. Now there is another chart similar to this that carries the same concept, which is the total 3 and Bitcoin pair, which we'll cover in just a few minutes. But it is the same concept, so I want you all to understand the concept itself. It signals the risk asset pair to traditional pair. Risk assets tend to outperform traditional assets only in environments in which there is an increasing amount of liquidity. An environment in which there is an increasing risk appetite, in which investors take more and more risks and seek more and more gains, first due to high inflation, and second because there is a lot of liquidity. Liquidity is extremely accessible, and mistakes can be made. That capital can be easily lost, but can be also easily replaced. So that's where these risk assets tend to outperform traditional assets. This is something we've seen back in 2020, 2021, when the Fed was adopting this quantitative easing program to stimulate the economy. And we've seen this major spike in small caps compared to, big caps and equities in the S&P 500. Since then, since the Fed ended their quantitative easing program and started to raise their rates right about right here, and then the total assets of the Fed start to top out. By the way, the total assets of the Fed represents the total amount of treasuries, mortgage-backed securities, other asset-backed securities, and everything that the Fed owns, through which they can either inject liquidity or take out liquidity from the financial system. So it represents a tool through which the Fed can control the consumption rates and can adjust according to how they feel or how they think the consumption rates. So that is what the total assets represents. And since they started a quantitative tightening program in which liquidity and the total assets start to go down, as we see here, so did the small cap to the S&P 500 pair did. Okay, so this is what quantitative tightening led to. This is what an environment in which there are liquidity outflows leads to. Now, why do I say we should have pumped off of this news? Well, low inflation means that there isn't room, right? There isn't the necessity of a continuation of a quantitative tightening environment because inflation already reached its target. There is no longer that fear that inflation may come back, or is it? And that's where the real inflection point comes in. This is what I said at the beginning of this conference as well. So normally the markets should have pumped due to the fact that they expect the quantitative tightening program to end and total assets to bottom like this, and so we'll have a macro catalyst that would change this underperformance. So if the reason for this whole underperformance was the fact that the Fed was reducing their total assets and continuously taking out liquidity from the financial system, well, once this ends, that should change, right? And risk assets should go on this trip to outperform for a medium period of time traditional assets. And that's also my base case. That's also my thesis that at some point in the next months, we'll see risk assets outperforming traditional assets as equity markets will enter the complacency zone. That's also something we'll cover today. But I do think that the markets didn't rally because they didn't expect it. So why didn't they expect it? Why didn't the IWM to SPX pair started to pump due to the fact that the markets were starting to price in the end of quantitative tightening and new liquidity that will enter the financial system and so forth? I believe the reason are tariffs. And we've seen a lot of tariffs being announced and a lot of uncertainty, especially with China. Now let me talk about the current state of tariffs. Trump has announced that he would put a 90-day pause on tariffs to negotiate with countries, okay? And he also reduced tariffs to 10% for every country and so forth. He didn't for China. He still is raising tariffs for China, and China is doing the same for the United States. And I think that this essentially puts China into the corner, and it is essentially an ultimatum of, will China bend the knee to the United States, and will China capitulate first, or will it go on a full-blown tariff war with China? And I do think that China eventually will lose. I think this is a losing battle for China due to the fact that most of their GDP is in exports straight to the United States. So if they stop exporting to the United States, yes, it will be bad for the United States as well. We've seen quite a lot of fears regarding astronomical prices, but that will also be extremely detrimental for China. Now, I think, looking at this, I think there are no winners from this whole tariff war. So don't get me wrong, but I do think that China will be worse than the United States. It will be bad for every country that is involved, but I think it would be worse for China, as their economy is in shambles. Their whole economy is in shambles. We've seen their whole financial system. So 60% of their whole wealth is invested into real estate, and their real estate market has been crashing relentlessly. So that is something to keep in mind, and I do think that eventually China will capitulate first, but I do not think that from this tariff war there are any winners whatsoever. So because of this, because there are no winners whatsoever, that leads to a lot of uncertainty. And uncertainty in monetary policies leads to uncertainty in the markets, which leads to market corrections. But now let's talk about yields. So yields have been on an absolute run. Now there are a lot of theories of why we've seen such a major spike in yields. Some say that China may be selling US treasuries to stimulate their economy or to punish Trump for imposing tariffs on them. I personally think it's a little bit of both. I think that China may be selling bonds, but I do think that the market is also saying another thing. The market is pricing in the fears of the Fed. And as I mentioned earlier, we are currently at an inflection point in which there are two main scenarios that can take place from here. The first one is my base case. That implies that all of these fears with tariffs will settle, the dust will come down, and that's when the fundamentals will take over once again. That's where the markets resume their natural uptrend, and the bond market goes, the yields go down, and so forth. That's the base case. Now there is also another scenario which is quite bad, that I think the bond market may be telling us that the Fed isn't cutting rates, that the Fed will wait this out more than it is currently expected. So let's say until August or September. And I know this may sound crazy. It's not my base case, as I mentioned earlier. But I think that this is what the bond market is telling us, that the Fed will wait. And even if it leads to an economic downturn, even if it leads to a short-term recession, the Fed will continue to wait it out until there are clear confirmations that inflation is not coming back. And I think that Powell is also fearing inflation potentially coming back with these tariffs. And if he rushes to stimulate the economy through rate cuts, and if tariffs continue like they've done over the last couple of months, and prices go astronomically high overnight, and if that stimulus comes in from the Fed with rate cuts, with a slowdown of quantitative tightening and so forth, then inflation will most certainly make a comeback. So that, I think, that is what Powell and the Fed is fearing, which is why we are seeing the bond market, which is, I think, what the bond market is telling us. So let's talk about the relationship of yields and the price action a bit. For those that do not know, the correlation is inverse, meaning that when the yields go up, the prices go down, meaning that somebody is selling bonds. Okay, so this is what it means. We have here the TLT. The TLT is an ETF for the US 10 treasuries, so for the 10-year treasuries, and so it represents the price itself. So while the yields have gone up, the prices have gone down. So the correlation is inverse. I wanted to clarify that. And so now let's talk about the correlation between the yields and the Fed, because yields have the tendency to front run Fed's monetary policies. So a lot of people are saying, some people are saying that, we will see rate cuts in May. Okay, so rate cuts in May. If we track what happened back in April and back in 2024, before we had rate cuts, the bond market was pricing them in. And we had this major downtrend until there was the first rate cut. And after there was the first rate cut, the yields have started to go up. And similar to now, until now, we had a similar downtrend, slowly pricing in the fact that the Fed will reduce rates and that more rates are coming and so forth. So this was pretty normal until this spike. Because we didn't have a rate cut. We didn't have the exact thing that happened here, in which the bond market priced in, and after we had this rate cut, then eventually the yields reversed. The yields have reversed before the Fed has cut rates. And I think this tells us that the Fed won't cut rates in May, at least. My base case is that they'll cut rates in June. And as I said earlier, there is the bearish case, which we'll cover in just a few minutes, for the markets, that would imply rates coming in August or September. So this is what I think the markets are currently telling us. And we've seen quite a lot of people, if we look at the CME Fed Watch tool, they think that there is a 40% probability that we'll see a rate cut in May, which is quite understandable. I've seen a lot of people screaming for an emergency cut due to the markets crashing. And I've seen a very similar thing also happening in August of 2024. If we all remember the yen carry trade crash, that's when a lot of people started to call for an emergency rate cut, which never came. So I don't think that, the Fed makes their monetary policies on the market's price action. I think that there are a lot more confluences to this. So I don't know. I'm leaning towards June. I don't want to see a rate cut in May. A rate cut in May, I think, would suggest a lot of desperation, a lot of panic from the Fed. If Powell cuts rates so soon, it would mean that they are fearing a deeper recession, even a depression at this point. If they would cut rates in May, I think that they would stimulate the economy because of absolute necessity. Trust me, I don't think, personally, I think that Powell is more conservative with inflation, especially. And I think that this is a personal problem for him. I think this is my personal opinion. Because of his mistake back in 2021, 2022, when they have overstimulated the economy, when inflation reached 9%, which is an astronomical number. After that mistake, I think that he will keep being as conservative as he can about inflation. And if it comes down to whether to choose an environment in which inflation makes a comeback or an environment in which economic growth goes down, I think he will choose the one in which economic growth goes down. And even if the United States falls into a short-term recession, I think he will still choose that one over the one in which there is high inflation making a comeback. And that again is my personal opinion on this, but I do think that it will keep holding rates at least until June, and at least until the dust settles with all of these tariff fears. And now, when we talk about the S&P 500 and the correlation between the S&P and monetary policies, if we look at this, we'll find something really interesting. And that is that the markets do not really pump based on how much liquidity there is in the financial system, or more specifically, how much liquidity is being injected into the financial system. So back in 2023, October of 2023, we've seen the markets bottoming out. And you might be wondering, well, why? Why did the markets bottom out? Why did we have this whole rally, even with rates being at 5.5%, which are the highest levels we've seen in over 20 years at that point? Okay, so since the 2000s, right? We haven't seen levels at 5.5% since the 2000s, early 2000s, okay? So these were very high levels. There was a full-on quantitative tightening environment in which, hundreds of billions were taken out of the financial system on a monthly basis. So there were every reason possible to have a continuation of the bear market here. So why didn't we? Well, I think, first of all, a lot of people were expecting it. So a lot of people were expecting bear market continuation. At this point, for those that were in the markets at this point, can relate to this. Down here, back in 2023, a lot of people were calling for this to be a bear market rally and saying that we should do something like this before we eventually bottom. And a lot of people at that point were also screaming for a recession. So I think that perpetual markets also played a role in this, as a lot of people were hedged, a lot of people were short on the markets, and so that only fueled the rally. But I also do think that a major role played the relative confidence of investors. And this is something that we all should pay attention to. The relative confidence of investors represents how predictable are monetary policies, how much certainty there is in the financial system, and what investors are paying attention to that makes them have either a lower risk appetite or a higher one. And in 2023, the Fed announced that they would top out rates at that point. And they were around 3 months into holding rates when the markets realized that that was it. And so that's when monetary policies became predictable. Due to the reverse repurchase agreement program, there was a lot of liquidity that could have been injected into the financial system that the Fed has drained, and that is something we'll cover in another day. But at this point, even with rates at 5.5%, the market started to rally because investors became more and more had a very high confidence in the markets, into the financial system. The monetary policies were very predictable at that point, and that led to risk-on environment. An environment in which monetary policies are predictable, in which there is a lot of certainty regarding the macroeconomic outlook, that is an environment that leads to risk-on sentiment, essentially. And we've seen Bitcoin having most of its bull market when the Fed stopped raising their rates, and that led to this risk-on environment. So why am I saying this? Well, I think that this is what we should pay attention to. Because the Fed, once again, is about 3 months into holding their rates. And the markets definitely seem to have this downtrend. And that's something interesting, because there are a lot of confidences forming between these two periods. And sentiment is the same. You know, down here, everybody was calling for a bear market continuation. What is everybody saying here? Isn't everybody screaming for bear market? Well, they are. So this is quite interesting to me. And I do think, and as I mentioned earlier, I do think that we do not want a rate cut right now. If we do see a rate cut, that would mark desperation. And that, I think, will lead to further, maybe it will be a very short-lived bounce, maybe, but that will eventually lead to a continuation to the downside. So what's my base case? My base case currently is like this, and let's talk about both the base case as well as the bearish case that implies that the Fed will wait it out even with a potential economic downturn in the books. So the base case is like this: the Fed will wait for a couple more months until June, 18th of June. That is the date in which the FOMC meeting will be. I think this will be where they will have their last rate hold, or maybe at this point they would even cut rates. And so that would put the last hold around May. So after that, we'll most likely see a rate cut, and I don't know how many points it may be. And after that, another period of rate holds. This, I think, will be the real deal. This, I think, will lead to that risk-on environment that we desire, and that leads to economic certainty and a risk-on period for equity markets. But on the other hand, I do think that it's likely that equity markets have topped out for this cycle, and that the next move up should bring us to a complacency zone. Something like this. So a period in which there is a lot of euphoria. And don't get me wrong, I do think that, so let me tell you this. Equity markets are very connected to risk assets. And this, I think, will be the period in which there is the distribution towards risk assets. This is where we will also have the macro catalyst coming out. And as we've seen in their last FOMC meeting, they highlighted that quantitative tightening will end somewhere this year, and that their best guesses was that it will end somewhere in this summer. So we'll have this narrative, and what we'll also see will be rate cuts. So we'll have two narratives on the table. First will be around the end of quantitative tightening and potential start of quantitative easing. So new liquidity that would enter the markets. And that leads to a lot of euphoria, a lot of excitement that, it's time to rally. It's time for stocks to go up. And of course, that coincides with potentially a complacency zone, right? If we see the sentiment chart, that is exactly how a complacency zone would look like. A period in which there is a lot of euphoria, in which there are high liquidity outflows, and in which there is a distribution towards risk assets. And we'll see in just a few minutes how will this impact Bitcoin and the rest of risk assets. But I also do think that because of rate cuts, we will have another narrative tied to a potential soft landing. And of course, both tied together, new liquidity that would enter the financial system and a potential soft landing with no recession involved. Think about that. Think about how great that would be. How much euphoria would that bring to the markets? And that's a very interesting question that I've been thinking about. So this is where I think we're headed next. And of course, equity markets could have a higher high. I don't exclude it, but I do think that there's a higher likelihood that equity markets have topped out and that the real rally right now will be in risk assets, not traditional ones. I think that for this cycle, traditional assets have had their rally and that now they should start this distribution range. So this is where my current stance is, and again, I may be wrong on it. And equity markets could have a higher high than start of the distribution phase. But this, I think, is this has a higher likelihood of happening that precedes the actual bear market that everybody is currently, fearing for. So this is the base case. Okay, and in this case, that would lead to a blow-off top in Bitcoin and risk assets, as we'll discuss in just a few minutes. Now, the cautious case, or more, the bearish case, is one that the Fed holds rates for a lot of months and continues on with their quantitative tightening program. We have no end of quantitative tightening, and so there will be no macro catalyst that would change this bleed of risk assets against traditional assets, and so we would not have any blow off top in risk assets. And again, this is the bearish case. It is not my current base case, but I do think that this is possible as well of happening due to the personal preferences of Powell and the Fed. And this is something I've been thinking about, that the next rally could be just this reversal, maybe a test of the prior resistance range, or the prior support range rather, that is now resistance range, and then the price is going lower, similar to this, and a continuation in the bear market. This is how the bearish case would look like. And in this case, the Fed is okay with the economy going into a recession just to avoid inflation coming back. In this case, I think we would need to see tariffs continuing, so no major deals being made. So for example, the tariff war with China continues in this case, and that leads to astronomical high prices, and because of that leads to inflation artificially due to artificial prices that aren't because of high consumption rates, but because of very high tariffs and very high taxes. Tariffs are a form of taxing. So I do think that this would be the bearish case, and in this one we would see another sharp sell-off, and this would be the bear market. This would be a 6-month, maybe 8-month bear market in total. This would be it. And then the Fed cannot take any longer with the recession. It cannot take, because at that point I think the Fed will just end their quantitative tightening program, will straight transition towards a quantitative easing program, and it would be something really similar to what happened in the pandemic, in which there is another global event, something very similar to what happened in the pandemic. They tried to wait it out. They tried waiting for additional confirmations to come in. The markets were rallying, as I mentioned earlier, with the soft landing narrative and so forth. Then a global event came out. I don't know what the narrative will be about this time. I think there are all narratives that intended to, but I don't think that this was the real reason of the economic crash. There was a solid economic crash that occurred in 2020, and it came long before the pandemic was even a thing, right? So there were clear confirmations, clear confluences that were building that suggested an economic downturn here, and it eventually came, but it also came with this very strong narrative of a COVID. I'm not saying that COVID wasn't real or any of those sorts, any of that stuff, but some things align. That's what I'm saying. That if this was a coincidence, it had a hell of a timing. And so I believe that once again, we're pretty much seeing the same thing, in which the Fed is at this inflection point where they have two main choices. So either inflation, and they choose the path of inflation probably making a comeback if they choose to continue on with rate cuts and end of quantitative tightening. And in that case, we would see a normal distribution in which there is an actual complacency zone forming, an actual blow off top in risk assets, and then we have a normal 2-year bear market. That would be normal to me. That would be pretty normal. In this bearish case, it would essentially lead to short-term pain for long-term gain, because this would be the bear market. It would end this quickly in 6 months. Okay? This is something I've been tracking, because after this correction, the Fed will be required to stimulate the economy, and so they will end quantitative tightening. They will cut rates really fast, so as they've done in 2020, and then the markets resume their uptrend, and we have essentially a V-shaped reversal driven by all the new liquidity that is entering the financial system. So that is something I've been thinking about, and is really interesting. And I do think that it is more likely that we'll see a normal distribution rather than this bearish case playing out. But it is a possibility, and it is something that we need to keep in the back of our minds. I do think that. And I do think that if there are certain bearish confluences that are forming here, certain macroeconomic developments, certain macroeconomic data that will come out at that point, that could lead to this. And at that point, I would hedge myself, and I will build a very rapidly cash position to position myself and prepare myself for this potential crash to continue. So these are my thoughts on the current macroeconomic side, on the current yield spike, in the latest spike in yields, and the future of Fed. So it is something worth tracking. Now, how will this impact Bitcoin? I know a lot of you are thinking about this as well. A lot of people are rather interested in Bitcoin rather than the equity markets, but I do think that tracking equity markets and traditional assets is very important, especially when we invest into risk assets. As we've seen here, if we would have tracked macroeconomics and simply this chart has told us this whole story. It told us this whole story for altcoins as well. And I do think that once it ends, that will lead to a blow-off top in risk assets. That will lead to an alt season, and that's also where the distribution phase actually begins in equity markets, in Bitcoin, and the rest of the traditional assets. Okay. And that's pretty much what I'm seeing right now. So how would this impact Bitcoin? Well, in the base case that I outlined earlier, in which the equity markets enter this complacency zone where there is a whole lot of euphoria, and market makers, this is a complacency zone. In complacency zones, market makers distribute. So in complacency zones, usually there is a very high volatility. So the markets go back and forth like this. This volatility results in high trading volume. And because of high trading volume, market makers can make bigger trades. Okay? That's how they can distribute. This is why in complacency zones there is this whole euphoric environment, because retail buys and institutional investors distribute. Okay? That's how it essentially works. And while there are a lot of liquidity outflows coming from traditional assets and traditional equities and safe assets, maybe risk assets go for a run in this euphoric environment, in this complexity zone. Generally there is a very high risk appetite, and so if there is a very high risk appetite, well, what that leads to is an increase in the price of risk assets, and Bitcoin goes up. And in this case, I think this will lead to Bitcoin going up and eventually starting off this distribution range higher. This is where I think Bitcoin will start its distribution range higher than these highs. So I think that equity markets moving forward will form a lower macro high, and that risk assets alongside with Bitcoin will form a higher high. Then the distribution phase begins, and once things end for equity markets, things will also most likely end for risk assets as well and Bitcoin. So these are my current thoughts. In the base case, this is how I see the impacts and the correlation of equity markets and Bitcoin. Again, this is my base case. This implies that we'll see a major distribution towards risk assets driven by these bullish narratives of the quantitative tightening environment ending, quantitative easing starting, new liquidity that is about to enter the markets, and a soft landing, and all of these, maybe, US strategic reserve, any narrative that is bullish will be there. Okay? And that leads to euphoria in the markets. And that is what I think, this is how the actual cycle top formation would look like. So that's my base case. Now in the bearish case, there is this sudden spike followed by continuations of the downside. I think that's how Bitcoin will most likely look as well. I think there will be a sudden spike, maybe some more strength here, maybe testing the all-time highs, but then failing and continuing this downtrend. That's something I would be cautious of. And I do think that if we reach these levels and we see unusual weakness in the Bitcoin dominance, and we see euphoria making a comeback, and we also see perpetual markets having some divergences with the price action and with the market sentiment. At that point, the market sentiment should be in complete euphoria. We should also have some bearish divergences forming, with higher highs forming in the price and lower highs forming in the strength indicators. Then that, I think, could precede a continuation to the downside. And in that case, I would build a cash position, as I mentioned earlier. I would hedge my portfolio and position myself for a potential continuation of the crash. And once again, also pay attention to the macroeconomic side, the macroeconomic data, the household data, and everything in between, because those will be the confluences that will tell me whether the Fed will keep this conservative approach, in which they'll wait it out. They'll even let the economy go into a short-term recession just to avoid bringing inflation back, but then ultimately fail to do so, and then being required to stimulate the economy. Then they transition towards a quantitative easing once again. And maybe that happens. Who knows? This is what they've done in 2029, 2020. That's the exact mistake they've done. They waited too much. If they do it again, then the same outcome will happen once again. But I do think that the base case is more likely to play out. And as I mentioned in my upcoming video on YouTube, as I mentioned at the beginning of this week, it will come at the beginning of next week. There is a higher likelihood that the base case will play out moving on from here, and we'll have a normal distribution of the cycles and so forth. And this, of course, wouldn't be a normal distribution by any means. It wouldn't be a normal distribution in the markets. It would certainly coincide with unusual distribution, market makers not being able to distribute everything. And we would see some really interesting developments, let's say, to say the least. So yeah, this is what I'm seeing right now with the macroeconomic side and with the correlations between yields, the stock market, between the stock market and Bitcoin, and the two potential outcomes that could go on from here, whether the Fed has a more conservative approach or whether the Fed will not repeat their same mistake that they've done back in 2021, back in 2020, 2021, and actually make some improvements and avoid waiting as much as they've done back then. So now I want us to have a look at the charts. So moving to a more technical side, let's say. Right now on Bitcoin, I've been paying attention a lot to the market structure. So the market structure, as I've mentioned a lot of times before, plays a key role. We want to pay attention to the market structure, not the narratives. And for God's sake, I forgot how many times I've said this over the last couple of weeks. You know, at every dump, there is anxiety, there is frustration, there is fear in the markets. And at every rally, there is euphoria coming back, excitement, bullish narratives, all of these things that do not make any sense. Does not make any sense to be bullish at range highs and bearish at range lows. So this is what I mentioned repeatedly, and I forgot how many times I said it before. We need to wait for a clear change, a clear structural change before we flip either bearish, before we flip bullish. It goes for both ways. We have no bias in the markets. We want to be as objective as we can in order to trade efficiently. If we have any sort of bias, and I tend to do that, I personally tend to be biased to be bullish on the high time frames, but still that doesn't mean that I'm reckless on the low time frames. As I've mentioned repeatedly, I've hedged myself many times before at range highs, then the price has gone lower and I bought a dip. That's what I've done over the last couple of months, and it has worked out perfectly. Because I'm bullish on the high time frames. I must say I'm biased on the high time frames. This is a personal issue, let's say. But on the low time frames, I trade like a trader. No bias, just pay attention to the charts, to the objective on-chain data, on-chain metrics that we can track, that we'll cover in just a few minutes, okay? But first, the market structure, as I think it is the most important one we should all track. So, a lot of people have gotten really excited, especially, so the Trump announcement on April 10th. So on April 10th, the Trump announcement of pause on tariffs led to a whole lot of excitement, right? We've seen a major spike in open interest. So longs were piling in. We've seen this major spike while the price was testing a resistance range. Do you know what it means? It means that a whole lot of people have gotten really bullish at range highs because of the narrative. So what did it happen next? We had a rejection. After the rejection, what did everybody think? That we would have another lower low. But here I said, well, maybe not. Maybe we'll have a higher low, and that is actually what precedes the next impulse up. So this is why I say, be headed at all times. Wait for confirmations before thinking that the trend has shifted. Here everyone was bullish. Here everybody was bearish. One day apart. What changed? The narratives did. The objective data was still the same. Okay? Then we had, as I mentioned in my weekend update, today, now we had, so I mentioned this, and now we had formed a higher low. As I mentioned in that previous update, we formed a higher low, and we have broken above this support range. Now once again, euphoria and excitement have returned. So after being fearful, now everybody has gotten really excited once again. This is where I say that we'll need further confirmations in order to see that the trend has actually shifted. Now, as I mentioned in my weekend update and in my latest YouTube video that you can all watch here By the way, if you do not follow me on YouTube, please make sure you do, because there are a lot of videos that will come out next week. So make sure you all stay tuned for that as well. And returning to what I was saying, now we need to see more confirmations that the trend has actually shifted. So no bias on the lower time frames, only pay attention to the objective data, objective market structure, and objective charts. Do not get biased. That is at all costs. So we broke above the key resistance zone after rejecting it the first time and flushing out foaming longs following the pause on tariff narratives. Now the big test is to reclaim this as a support range. So if we get below it, then that essentially means this was a failed breakout. This is what it is called. When the price gets above a resistance level, but then fails to hold it, that is a failed breakout. If this ends up being a failed breakout, we risk seeing another leg lower, deeper into the high time frame support range at $72,000, and just a continuation of the trend and the downtrend we've been in since January. All right. So now, once again, we'll need to wait for a clear confirmation that the trend has actually shifted, and that would be a break above the prior breakdown point at $88,600. So that is right now, I think 3 to 4 to 5% or so away from current levels, and that would be a confirmation that the trend has shifted and would mark an extended break of structure. Now I explained this quite a lot over the past few days. What is the difference between an internal market structure and the difference between an external market structure, and why we need to wait for an extended or an external break of structure that would confirm that a trend has actually shifted on the high time frames. Because until then, so let me actually go on to the charts so you can all understand a bit better. So until then, okay, what do you notice about this chart? Something about this chart is the fact that it is a downtrend. Okay, now you can take resistance, for example. What do you notice about this chart? Well, you see that each time, the price tried to break above this resistance but failed. And so now we need to see a confirmation that it is actually breaking out. So what would be a confirmation that it has broke above this? Well, first I would want a break above the prior breakdown point at $88,600, right? In the last couple of months, we did not see a break of structure. This was the high, then this was the high, the prior breakdown point, then this was the prior breakdown point, then this was the prior breakdown point, then this was, then this one, then this one. So do you notice something about these breakdown points? They are never getting tested. They are never getting triggered. And you may go deeper into why this happens in the first place. And my argument for that is that market makers are preparing a reverse liquidation cascade. So I don't know if you guys remember the thesis about the liquidation cascades. Considering how many times I've covered it throughout all of these past weeks, you should. Essentially, liquidation cascades occur once there are some liquidity levels that develop, and they are never getting touched as liquidity fills this level. So these liquidity levels mark essentially market inefficiencies, if you like. So points where liquidity is not getting triggered, right? A normal market structure, an impulsive one, should look something like this. You have the initial wave 1, then you have a corrective wave 2 that triggers this last low, and then a bounce on higher, impulsive, and healthier than this. Now in this market structure, these lows never get triggered. And because of this, when a certain news comes out, you have a very sudden market correction that sweeps all of these untapped lows. Okay, That is the whole thesis. It has happened before. So it has happened once in early March. It has happened back in late February once again. There was this series of untapped lows. This is what helped me to hedge myself against all of them by identifying this series of untapped lows. It has happened once again here. So even in late January, this was the first liquidation cascade. Then once again in early February, once again in late February, once again in early March, and once again in early April right now. This is pretty much the whole story about liquidation cascades and why they occur. And the reason for why they occur is that market makers can create an artificial counterparty by triggering all of these untapped lows. So at all of these untapped lows sit stop losses of traders, and specifically retail traders that set their stop loss at the nearest support level. So if I would like to take a long position here, where would I set my stop loss at? Well, the basic of technical analysis says that I would set my stop loss at the nearest low, which would be this one. If I would like to take a long position here, where would I set my stop loss? You're right here and right here. If I would like to take a long position at this low. So because of that, once an event comes out, all of these stop losses get triggered. And if you think deeper than that, what a stop loss of a long position is, it represents a forced sell order. And a forced sell order needs a counterparty. And that is when the market makers step in, and that's how they buy. Through forced sell orders. So if you don't have a counterparty, if you don't have somebody that is willing to share, willing to sell his share or his coins or his bitcoins and so forth, then you force them out of the market. That is how they do it. And that is something I've noticed over the last couple of months. This has helped me hedge at each time. So now returning to what I was saying earlier about the reverse liquidation cascade. Let's invert the scale. What do you notice about this chart? Isn't this interesting? And I think it is. And this is where the whole thesis with the blow off top phase in risk assets also comes in. If we see a complacency zone forming in the markets, then this could lead to a blow off top in risk assets. And that would essentially lead to an inverse liquidation cascade that would trigger all of these untapped lows in this case, but in reality they are untapped highs. So that is what I'm currently seeing. This is what I'm currently tracking for Bitcoin. And yeah, with that being said, that's pretty much what I'm seeing for the markets. In general, this has been quite an amazing talk, quite an amazing conference. I've covered quite a lot of topics today, and this meeting has been recorded. So if anybody wants to look at it again, you can do so. I will post the recording soon here on the Discord channel and on YouTube as well. I would like to thank you all for joining today's conference. It has been truly amazing, and I truly appreciate holding these conferences with you guys. You are amazing. I want to express how grateful I am for being able to share my thoughts with so many people. So I appreciate all of you for being here. And if you've enjoyed it, please make sure to spread the word about the community, about what we do here. And I'll see you guys in the next one. I wish you all a wonderful weekend, and stay tuned for future videos and updates that will soon come. Have a nice day, everyone.